Hi, good morning and good afternoon, good evening in different parts of the world that you might be logging in from. My name is Numan. I'm a consulting actuary from Lux Actuaries and Consultant. I've recently qualified as a fellow. I'm so recent that my name is yet to be published on the Society of Actuaries website on 5th of November. I'm speaking on behalf of RCL because going forward, RCL might be working with Lux Actuaries who are based in UAE. We are the largest actuarial consultancy based in the GCC. So we have been working actively in this part of the world for about almost a decade. And we work on the non-life and life insurance lines of business along with some banking work. So there's an opportunity for a lot of insurance and banking related work in the East African part of the world coming through Lux. And of course, we are working with RCL. The purpose of today's session is to update this market, the Kenyan market, as well as the East African market on IFRS 17, which is the latest accounting standard recently proposed by the International Accounting Standards Board. The accountant is set to go live in 2023. The final draft was recently issued earlier this year, but due to COVID-related restrictions, it's yet to be finalized yet. So the final version of the level, which will be probably out in the last quarter of 2020 this year. Yeah. All right. So that's it about me. We have just one more disclaimer though. We have done a fair bit of IFRS 17 related work in this part of the world in the GCC, Saudi Arabia, UAE, Bahrain, and Oman. These regulators have taken some actions for IFRS 17. So I'm here to present you the standard as well as the findings from this part of the world. So without further ado, I'll just move on to the standard. No disclaimer, no about me slide. So I'll just jump straight to the standard. All right. So we will be speaking about the standard IFRS 17, the standard itself. There will be an overview of the standards, a walkthrough on the stakeholders, because this is supposed to be an actuarial seminar. But I will walk through on the different stakeholders who will be involved, because even though this is an accounting standard, it is important to realize that it involves many stakeholders from different lines of business within an insurance or a reinsurance company. I'll give you an overview of what's changing within the standard, what kind of measurement approaches are there specifically for actuaries and underwriters, some transition calculations for the in-force business, what will be the revised KPIs, and of course, a summary, but within the summary, I'll be also talking about some lessons from the GCC market. All right, so overview of the standard. Just to give you a background on the current insurance accounting, even though this number is 17, the current accounting standard is IFRS 4. And this was launched, this was supposed to be an interim standard launched in early 2000 or the late 1990s. This was supposed to be a replaceable standard. However, IFRS 17, which was supposed to be the final destination of the International Accounting Standard Board, took some time to be developed. And that's why it has taken a long time in the making. You can see here, I'm not going to read everything on the slide because this slide is just supposed to be an introduction. But what's important to know is that there were lots of meetings which were conducted. There were lots of roundtables. Even as of now, when the first draft was issued in 2017, after that there were transitional resource group meetings based on which the standard was. There were some targeted changes. There were some changes on the reinsurance side, on the measurement side. ISB has performed a really good effects analysis document. If you are new to the standard, that's what I did as well, by the way, because it's just a really good place to get started. So if you're worried about the standard, my solution is, again, and that's my personal opinion, don't go read the standard. You might get confused. A good place to start is go to the ISB website, download the IFRS 17 effects analysis document, and read about it. It gives you a very good idea about what's IFRS 17, what's changing. It's a pretty comprehensive document, I think about probably 100 odd pages, but it gives you a good overview. It tells you about the different insurance companies, but that might be targeted, what's changing, different jurisdictions, and how things are changing. Because you have to realize that there are localized gaps in every part of the world, and IFRS 17, even though even though it might be finalized by the ISB, it might take some form in the form of it might be some modifications in the form of localized gap, but definitely not some major changes. So again, the timelines here: 2017, the first draft was issued. After that, it was postponed to 2022, and now, since the advent of COVID earlier this year in June, I think in March earlier this year, it was postponed to 2023. It's set to go live in 2023. There is a lot of push from mainly European insurers to push it another year ahead. But then that's ISB's call. We are not sure what's going to happen. But regulators in every part of the world, specifically since I'm from the Middle East, from the GCC market, have been really active. They've been really active and they're pushing for lots of changes. So we concluded a gap analysis in early 2019. Then there was a financial impact assessment of comparing IFRS 4 versus 17 income statements and balance sheet only for one underwriting year cohort. And now in the third phase, the regulators are pushing for implementation plans, and a lot of implementation work is being carried out in this part of the world. From what I've seen from the Kenyan regulations or from what I've read, it is picking up pace, but nothing solid has started. So gear up for a lot of changes in the next few months potentially. Coming back to the stakeholders, so that brings me to what to what I was talking about initially. As you can see on the slide, there are a lot of stakeholders involved with the standard. Since this is an accounting standard, there is a whole lot of involvement between underwriting and claims, and that's an insurance business starts from. People who write the business, people who take care of the claims. Once they do that, there's a reinsurance department who's involved for the risk appetite of the company, figuring out what are the reinsurance limits, what's the company's retention limits, and then it all goes on to the IT department. There's an HR involvement potentially, because HR is involved, must ensure that there's a smooth running of insurance operations. So the company must have the qualified and the right individuals. And then comes us actuaries. At least I'm hoping most of us in the audience are. So yeah, us actually calculating the liability part of it, or performing the pricing part of it. So we go in hand with the underwriting, claims, and reinsurance function, and of course IT being the most important resource for us to provide the data. Once we have everything, it all goes to finance. Finance prepare the financials, and it all goes out to the board. So it's just a perfect streamlined function, and that's where the standard will target each and every areas of the insurance company. So what's changing? Just like every accounting standard that comes out, IFRS 17 also is divided into four main sections. That is recognition, presentation, measurement, and disclosure. In recognition, there are some prescriptive, I can say, guidelines on how insurance and reinsurance contracts, when and how they are recognized. So again, that's straightforward. But on the measurement side, it is turned into a principle-based model. There's a lot of push and there's a lot of change in the global regulations, and things are moving towards more on the principle based side as opposed to prescriptive based. One example is Solvency II in Europe. Another example is US GAAP, where there is a lot of principle based calculations. Just like that, IFRS 17 will be more principle based, implying that there will be a lot of judgment call from the actuaries. Things are not prescriptive per se. Once you measure an insurance contract, you're required to present it. So hence comes the presentation part, which talks about disclosure, which talks about balance sheet and income statement. Once you have the presentation, there are a lot of disclosures. IFRS 17 contains a sea of disclosures, and you need to disclose everything in your financials. So whatever you will be measuring will be going out in your disclosures. The good part is, if you can automate it, that'll be perfect. The bad part is lots of disclosures. I'll move on to the details. The devil is in the details, and there we go in the next slide. I personally love this slide. Whenever I've presented IFRS 17, I prefer to use this slide because it gives you a snapshot view of the standard all in one place. So you can see in the indigo side on this presentation, the indigos are the previous slide: measurement, recognition, presentation, and disclosure. I'm not going to drill down into the disclosure side, but on the recognition side, you can see there is some discussion on the scope, about risk, about profitability, and about issue years. Once we're done with recognition, then we move on to measurement, and that's where a whole lot of work needs to be done by us actuaries. We need to know what needs to be measured. So there are three calculation models for IFRS 17: the general model or the building block approach. the premium allocation approach, and the variable fee approach. And within these, each approach, there are different calculation types. You can see a red there, which is an onerous contract. That's where you need to be careful about. These are loss-making contracts. I'll come on to that probably at a later stage. Then we have presentation, again, the balance sheet and the income statement, and finally disclosures. So a good snapshot view of the standard, what are the components, main components at least, if not all, and in addition to the main components, what are the pieces within each part. So within general model, you have the contractual service margin, risk adjustment, discounting, and fulfillment cash flows. I'll come to each and every sections just in a bit in the next slide. Just moving on, when we some key considerations before moving, and you need to realize that this is an accounting standard. It will change the way profits are recognized. So currently, your profitability is different. And of course, about the initial assessment of insurance contracts, it talks about separating the derivative part and the investment part, because in some parts of the world, these are interlinked. They need to be moved out. Profits are supposed to be recognized over time as opposed to everything at recognition. And of course, you need to apply it retrospectively, implying that in Jan 2023, when the standard goes live, you need to ensure that you have the calculation for all the previous cohorts. So lots of work for life insurers. What's the change? Again, like I mentioned initially, there are some localized gap, and then the issues around IFRS 17. So nice slide, clearly identifying the changes. For instance, the change in the insurance, the accounting for insurance contract, estimated claims, you need to have the right estimates at the initial recognition. Currently, there is no non-financial risk is not taken into account when pricing contracts. IFRS 17 requires to do so. Long-term accounting can be arbitrary. Things can change between jurisdictions, so you need to have the right measurement model. And loss is recognized only when incurred, whereas IFRS 17 goes with the concept of prudence and says you must recognize immediately or at initial recognition when the insurance contract is written and you know that's a loss-making contract. So some just initial thoughts or some snapshot points, a summary of what are the changes within the contracts. And that brings me to the measurement, which was my initial slide. There are IFRS 17, as actuaries, you should know that IFRS 17 talks about 3 different measurement models. The first one is a building block model, which is a standard model, which is the model which is a mandatory model applicable on all insurance contract. A simplified version of that is a premium allocation model, and then the specific model for participating for contracts with a lot of participation is a variable fee model. You can see that on the last column, I've highlighted that building block is default. PM allocation, which can be applied to contracts for term less than 12 months, is optional. And then variable fee is mandatory for all insurance contract where there is a direct participation feature. For example, where policyholder can have some kind of profit sharing, or policyholder gets a direct participation in insurance contract and gets a return similar to the TACAFL, but there are again no guidelines on the TACAFL side, but similar to those kind of contracts, mainly applicable on the life insurance contracts where you have participation, not on the non-life. But non-life for long-term contracts like engineering, you can have the building block. For short-term like medical motor, you need to apply a premium allocation approach. The transition approaches, because you need to have the full set of financials ready before the end of before 2023. There are 3 different transition approaches. The first one is a full retrospective approach. The second one is a modified retro, and the last one is a fair value approach. In a fair value approach, it's very straightforward. You just come to 31st December 2022, calculate the fair value of insurance contracts. You calculate whatever the fair value is, whatever the selling value is, and just take that and book that as a liability. Now, that's very straightforward. But in a full retro or a modified retro, things are pretty different and hard to calculate. I'll give you an example of a life insurance contract, which was retrospectively written in 2021 or 2022. And you need to calculate the liability, that is the risk adjustment, and the profit amount, that is the contractual service margin, as of each year, and carry that forward and unfold it over time. That's full retro. And modified retro is whenever you don't have the right information available, you can apply some kinds of adjustments. Again, since I'm short in time, I'm not going to get into the details of these, but there's a whole lot of work that needs to be done on the transition. And then the purpose of this slide is to make you aware of the transition calculations. There are some new KPIs under the standard. For example, insurance service revenue, insurance service expense, net operating income. These are about to remain the same. Not a whole lot of changes here, but the standard introduces some new KPIs like the contractual service margin or the risk adjustment. CSM is your not profits which are amortized over time. Risk adjustment is your extra margin. And then you can see the remainings are more or less the same: solvency ratio, technical margins. There are some changes in the way insurance in the way insurance contracts are accounted for. But wherever there are changes, you need to know what are the changes for. You need to be aware of the changes. You need to read them carefully, because the KPIs will change, but they won't change drastically. And lastly, to summarize, we know that IFRS, it's not that we know, I've touched upon that in the previous slides, that the standard is going to transform the role of actuaries as well as the finance department. And there will be a whole lot of coordination between these two departments. Not even within the finance and actuarial, within the actuarial teams, because traditionally actuarial roles is divided between the pricing side and the reserving side. Even between those teams, you need to have a whole lot of coherence. They need to work together in tandem, just so that they know what are the extra margins, extra risk adjustment, whatever, and of course the profitability at the initial recognition. Risk adjustment is one part which needs to be linked to the company's risk appetite. Company needs to know what's the risk appetite, and they need to tie up the risk adjustment, that is the extra risk they are bearing, so that it can be disclosed within the financials and the stakeholders can see what's the extra risk within insurance. There is a significant operational impact. We have seen it in this part of the world. A whole lot of work needs to be done on the financial side, on the data side, and on the actuarial side. So it's going to transform the way the actual and financial function will evolve. So my advice is start looking for system vendors. In addition to reading the standards, start looking at system vendors. So start looking at financial system vendors, operational system vendors, as well as actuarial vendors. If you're not aware of what's happening, start reading articles about their offerings and the things that they might be changing. Lot of changes for the long-term insurance, right? Long-term insurance companies who writes life insurance contracts, they might have to segregate the derivative part along with the direct participation part. And then in addition to that, come up with different cohorts of the previous underwriting years. So it will make things operationally difficult to them. And of course, any simplification that might be made due to wherever your data is lacking, they need to be addressed. Not now, probably later, but they need to be done ASAP. Thank you for the session. Thanks for listening to me. Since I had to wrap up IFRS 17, the standard in a short span of time, but I tried my best to make it easier for everyone. But please feel free to reach out to me if you have any questions regarding the standard. Thank you.